Hey y'all, it's Austin Lampson, and I'm coming at you today with a class on reverse mortgages. Why reverse mortgages, right? Look, they've got a really bad rap because they used to be not so awesome. But I'll tell you, we're finding more and more clients seeing this as an opportunity because their equity is building faster than maybe some of their savings. So, prime example, the reason I personally got licensed to do reverse mortgages is because a client came to me, love her. We've worked together for about 15 years and her husband had passed. And she said, Austin, like my husband's passed, my house is too big. At some point, I need to downsize. But in order to care for him, I've spent the majority of our pension. So she doesn't have a lot of resources to fix up the house, to move to the new house. And I was like, my name's Rose. I'm like, hey, Rose, so let's talk about a reverse mortgage. That could be a good option for you. So to be clear, the whole goal of this is so that you understand a bit about how they work because everyone's unique scenario is going to be individualized for you and to give some broad strokes. I would also say that personally, I'm probably going to do a reverse mortgage. We've gained a lot of equity in our house, which is very, very fortunate. And I don't necessarily need to give that equity to somebody else when I pass on. That is for me. I can give them my assets instead. So, this is about wealth preservation. This is about sustainability. This is about being able to age in place if that's something that aligns with you. All right, so I got some slides, love a good slide. So I'm going to go ahead and start this sucker out real quick. Um, I really want us to start just talking about the 411 around this, right? Like, what is this about? This is knowing your options and directing your future. So, first and foremost, let's bust a couple of these myths, right? So, number one of the biggest concerns people say is like, oh my gosh, I'm going to be forced to move. Well, that's not true. As long as the terms are met, right? Like, someone is living in it as a primary residence, you're maintaining it, right? You're paying your property taxes, you're paying your insurance. You cannot be forced to sell your property or be foreclosed on, no matter how much you owe. Number two, heirs could owe more than the home is worth. No, no, no. These are non-recourse loans. Now, a reverse mortgage means that the interest is gaining over time. A forward mortgage means that you're paying it down over time. So it is absolutely true that at the end of the term, when you've passed on, your heirs may have a balance higher than the house is worth, but they are not responsible for that. That is why these are created because they are non-recourse. This is an equity property concept only. And number three, monthly payments are required. Also not true. It is optional. You do you, right? If you feel that that's something that we want to do and we want to pay these monthly payments, we want to pay our interest, awesome, fantastic. That is an opportunity. It is optional. It is not required and it is not prohibited, right? So any payment stops the interest compounding. Again, the reverse mortgage, the interest is going to gain. The forward mortgage, the interest is going to be paid down over time. But you cannot have to pay that monthly if that's what suits your needs at that time. So how do you actually qualify for these? There is a financial assessment requirement. Most people are like, oh, well, you just old, so you get them. It's like totally great. No, but that's not true. This has to examine the willingness and capacity of the borrower to timely meet their financial obligations. There is no debt to income calculation. It's different. It's based on a life expectancy set aside, right? Like, how long are you expected to live? Do we have enough income or assets to pay these items? So, looking at your credit history, have you been on time, right? Are we delinquent in taxes? What about your rent? Because yes, you can use a purchase and a reverse mortgage at the same time. And it's based on residual capacity cash flow. So it's how much is left over. Now, fun fact, if the loan ends with an A, it is a government loan, and those are qualified differently. So most reverse mortgages are FHA loans, right? If you're thinking about a VA loan, maybe some of you are veterans out there, you're used to this residual income. It's not what you pay, it's what's left over to be able to meet your financial obligations. So again, you're going to have this life expectancy set aside. This is a mandatory impound account or escrow account set up for life so that your taxes and insurance are always covered. Why is that? Well, taxes are liens that supersede your mortgage. You could have a $10,000 tax bill, $1 million mortgage, and if you default on the 10,000 tax bill, they can foreclose on your house. That is how that works. And insurance, of course, because the property needs to be able to be rebuilt. If something happens, that property is the collateral. So that's why it's so important there. So, how do you actually determine how much you can borrow? Well, look, the loan amount, this is called the principal amount, right? The initial amount that we're borrowing has three factors. So, borrower's age. So, HUD, Housing and Urban Development, they regulate FHA loans. So, that again, these are based on FHA loan programs. So, they use the nearest age or the youngest borrower, right? So, think about it this way: the older you are, the more you get, the younger, the less. Now, fun fact, you don't have to have both borrowers meet the minimum age requirement. So let's move into the expected rate, right? The qualifying rate, again, we're talking about residual income, how much is left to pay all of this, is used to project the interest accrual, right? So if rates are lower, then it's not going to gain as much over time. If rates are higher, as they are a little bit, then you're going to see it gain higher over time, and therefore you can borrow a little bit less, right? Now, the maximum claim amount on a HECM, home equity conversion mortgage, that is the nerdy little term that is called a reverse mortgage, is based on FHA with 2024 numbers $1,149,825. Yes, it is 2026 when I'm recording this, but this number is still kind of in play. It's a good threshold, I think, overall. But jumbo options exist because if you're in certain parts of the markets we serve in Hawaii, in Washington, in California, in Colorado, Arizona, Texas, Florida, right? Like, you've got some properties that are worth well over $1 million, and that might not serve you. So jumbo loans are going to be different on the reverse mortgage world than your standard HECM, your standard FHA, your standard HUD type of products. But we'll get in that a little bit down the line. So expected rate and maximum claim amount. Now remember, the maximum claim is the maximum that it could grow to. So we had that principal, and they did this life expectancy, they did the interest rate range, and they're like, okay, the max is how much it could be, right? So the expected rate for this is really based on this 10-year version, right? This 10-year CMT. You can Google it, you can see the whole history of it, of how they fluctuate it. And then again, that 2024 number is $1,149,825. It's so random, these numbers that they come up with, but these are algorithms that drive it, right? So properties that are above this threshold may do a jumbo loan. So don't be concerned that this could be a limitation for you because you have opportunities, right? Now let's talk about variable rates. You've got a couple different ways that you can structure these HECMs, these reverse mortgages, right? So a variable rate HECM is similar to a traditional line of credit, HELOC, home equity line of credit, right? Now this is going to be variable and it can be drawn on over time, right? It can change as you get older. You can say, hey, I owe 500. I'm eligible for a 700 loan. You can pay off that 500 and get that 200. That could be increasing over time, right? But the unpaid principal balance is how much you take initially at closing. This is how much I want. Thank you very much. Let the rest grow over time. So again, that principal limit is going to be the line amount, right? The expected rate is the qualifying interest rate based on where things are today. The maximum claim amount, again, we're leaning into that FHA level, or we're going to look at some jumbo options. And the unpaid principal balance is the initial draw that we're taking. So these are a couple different factors when you look into it. Closing costs. Closing costs are different. They can be more expensive, right? So it's based on 2% of the maximum claim amount. So in that last example, let's say that we were taking 500 today and the maximum claim amount was 700. The 700,000 is what's going to drive the percentage that you pay at closing. This is the reason because it protects both the borrower and the lender if the home isn't enough to cover the balance. This is set by the federal government. Doesn't matter if it's me, you're another lender down the street, Joe Schmo down the line. This is set by the federal government. This is set by the federal government, right? So this is what they say. When they change it, that's a policy concept. You've heard me probably squawk about policy before versus actual rates. Now, this is going to change over time. So again, that origination fee is the greater of $2,500 or this 2% amount of the first $200,000 of the home value plus 1% of the amount over 200. Yes, that's kind of funky math, but don't worry. If you really are looking at these options, You have to review a proposal. There is education around this. It's not a one and done. Now, this is a traditional mortgage in the sense that you're going to have those third party costs as well. You're going to have title insurance. You're going to have escrow for an escrow state. If you're an attorney state, you're going to have attorney fees, the appraisal, and more. So you're going to have your traditional loan costs plus the origination costs that are set by the federal government, right? So this, again, this initial mortgage insurance premium is 2% of the maximum claim amount. Typically, that's rolled into the loan amount. If you're used to a VA or FHA loan, they've got a funding fee or upfront mortgage, and they roll that in. And then the origination fee is what's going to range, but there's a cap at $6,000. There's a cap. You can have a $6 million loan and still only have a $6,000 like origination fee, right? So fees can exceed when it's a proprietary program. So all these fees limitations we're talking about so far are in the that 1.149 number. If we're looking at the numbers higher than that, then it can change based on that investor. So let's talk about those investors. Let's talk about proprietary reverse programs. Let's talk about these jumbo programs because with all due respect, again, a lot of our markets are over $1 million in value, right? So FHA we know has that limit. However, if we're looking at these jumbo programs, they're going to function similar. You could have a standard fixed, right? I just borrowed my 500. I don't need any more than that. You could have the variable. I really just want the full thing on a $700,000 line of credit. I'll take 500 now. I'll let it go over time. You can have a mix and match. But the big key here is that the borrower eligibility starts at age 55. Your traditional for your FHA is 62. Now I'm going to pause there, right? The state of Texas is different. Y'all at 62 no matter what. 62 no matter what. But age 55 has to be one of the borrower or non-borrowing spouse, okay? So, therefore, if I am 62 and my spouse is 49, we may not qualify. If I am 62 and my spouse is 55, we can qualify, right? So it's the younger of the two, right? Now, in the state of Texas, again, it's 62 overall. So these are really good for these higher value properties. These are really good for folks that maybe are retiring a little bit earlier and again have a huge equity gain and they want to use their equity for their life, not necessarily their assets. Because let's face it, the market's a little volatile right now, right? So there's a lot of different variations on products, and that's something, again, that we can get into your personal specifics. So a couple more facts about this. I thought it was interesting as we're leaning in. You know, reverse mortgage is a loan of last resort. Like, that's not necessarily true. So, talking about Rose, like, I could still qualify her for a forward mortgage, but that's not necessarily in her best interest. Her best interest is something that suits her lifestyle and her needs. And she's like, I feel heavy with this, Austin. I want to be able to have more freedom in the current cash flow because my pension that we've used a lot of is flexible and it makes me nervous, right? It's not a last resort. She has other options, but she wants to do this. I want to do this for myself, right? And again, leaning in that both spouses have to be over 62, but only one, except for Texas. Love y'all, right? But only one really has to be over 62. So the eligible non-borrowing spouse can maintain in the home even without monthly payments if that older one passes. So again, in the example, one spouse is 62, the other is 49, right? And we're basing on there. Or so let's just say they're 62 and now they're 60 or whatever, right? The concept is though, once you have that reverse, as long as this other person is living in the house, even though they're not that primary borrower, even though they weren't that initial age, they can still stay there. They're not going to get kicked out, right? Now, if you all move out and turn it into a rental property, yeah, it's not going to work for you because these are supposed to be for primary residences. So there's a lot of random stuff you have to know about reverse mortgage. And I know this is a very big slide. So take your screenshot. Let me know if you need me to send it to you. But you have to do HUD counseling, whether it's a traditional FHA backed one or whether it's a jumbo program. You have to do HUD counseling. And it's okay to do it over the phone, doesn't have to be in person. But then there's an 8-day waiting period. And the intent around this is that you can truly think about it. Get the right counsel that you need. The intent is that people know and understand because we hear a lot of horror stories of like, I have a situation right now where it's not our client, but a realtor came to us and said, gosh, the woman would give her niece a bunch of money to buy a house. The niece just told her to sign this paperwork. She did not do the counseling right? Somebody pretended they were the aunt and they weren't. And now this woman has a whole bunch of money and it's messed up. No, you as the borrower need to do the counseling. You deserve the counseling. You deserve that education to be sure that this is the right decision for you, right? So once that 8 days have passed, then you can order the appraisal. Then you can proceed forward, right? Now, once the appraisal's in, closing can go pretty fast. It can be 2 weeks, right? But this is all driven by you, right? We're going to do our proposal. We're going to do your counseling. We've got to wait our 8 days, and then we can order the appraisal. So you see that if you're doing on a purchase on a 30-day period, yeah, we got to move and shake, but that's how that works, right? There are no rate locks. The rates are the rates are the rates, right? There's no rate locks. You're not worried as much about, oh my gosh, did it change today, right? And if the appraisal exceeds 2 million, so if you're lending on a property that's worth over 2 million, a second appraisal is required, but that's not on you. That's not part of your closing costs. That is not allowed, right? Now, condos do need to be FHA approved. This is a really big deal as condos are changing. You can do a spot approval, which is like a single approval, like one and done, not the whole project, right? And deed restrictions for age are permitted. So here in Santa Barbara, we've got Encino Real, we've got Shadow Hills. These are deed restrictions for age only. Now, deed restrictions like affordable housing, right, where you have to sell it within the program, those are not allowed. So let's pay attention to some of those. That's not necessarily everyone's world, but if it is yours, I want to call attention to it earlier, right? And trust vesting is okay. Even revocable and irrevocable options. An irrevocable trust is typically happens when you have two trustees and then one passes. The trust says, oh, can't change anything until the second one passes and then it distributes. But in real life, like as we have that example, one spouse typically outlives the other. And as long as this is for the primary residence intent, we can work with that. And a fiduciary is okay. Now, I got to tell you, I have a really good friend that's a fiduciary. Love her to pieces. She does great work. She challenged me 5 years ago to figure out how to do these because what she's finding is there are folks that are still want to age in place in their house, but they're using her as a fiduciary, right? A fiduciary is either a court ordered person or someone that's assigned to take care of this person because they are not in the mental capacity to do so. So yes, we do need additional processing on that, right? You got to make sure that all the rights are there, but that is able to be done because a lot of us need extra help as we get older and our minds aren't as clear. And that's just how our brains work, right? Power of attorney is okay. Perhaps we have a situation where both are still alive and one has dementia, right? But they sign that power of attorney in front of the doctor legally, everything before before that they were incapacitated. So yes, we can use that power of attorney. So the spouse that still has all their facilities can sign and take this loan. There are options. This is real life that we're talking about, right? And last but not least, divorces. I also had a friend that's a really good divorce attorney. She's like, Austin, people are doing these silver divorces, the gray divorces, and they need to be able to stay in their property. They need to be able to understand what their options are, right? Again, they may have more equity than they want to buy out their spouse, but it has to be finalized. It has to be finalized before we start the process. So again, state specific, Texas, y'all got to both be over the age of 62. Washington and Florida, heads up, your title costs may be higher than other states. That's simply the way the insurance works in your land. So you're going to get a proposal. And once that proposal is prepared, we're going to sit down and review it. We're going to talk about it. We're going to talk in real time before you even start on the counseling. Like, we want you to understand these options. So, is this the right thing for your family? You decide, right? Do you think your equity is going to grow faster than your spending needs? Has it already? Would you be using accumulated assets instead of savings and have tax consequences, right? Like maybe it's in your 401k and you need 100 grand. Well, you take 100 grand out of your 401k, that's over and above your required minimum distribution. You're going to pay real tax money on that. That might not serve you. Or is selling or downsizing a better option, or is staying in your home more important? These are questions that you have to answer and that we can go through together. It's all about going through the risk reward, the pros and cons, so you have the opportunity. Every scenario is different. So let's find out what works for you if this is something that you want to explore. And if you have a unique situation, give us a call. This, again, no judgment, all opportunity, all curiosity, all ways to support. My name is Austin Lampson. I'm here at Origin Point today, and we are grateful to serve you and anybody you know all along the West Coast, including Hawaii, Florida, and Texas. You've got options. Let's understand them together. And if there's any questions, please reach out. Again, This is about educating you and opportunities. I'm grateful to serve you. I hope you have an amazing day, and I'll talk to you soon.